Welcome to This Explainer. Today we're diving straight into the high-stakes world of international development, and we're going to unpack a massive pitch deck together. We're going right past the glossy marketing to dig into the hard numbers, the legal safeguards, and the actual operational realities of a multi-million-dollar hospitality project.
So the headline offer we're looking at today is for the Sorsogon Coastal and Marine Eco Resort and Marina over in the Philippines. It requires a pretty massive $10 million investment facility. Look, when you're deploying 8 figures into an emerging market, the details absolutely matter. So let's find out exactly how every single dollar of that is protected, utilized, and most importantly, eventually returned to us. To properly evaluate this, we're going to follow the complete investor's journey. We'll look at the pitch, the structure, the funds, the returns, the risks, and finally, the exit.
Starting with Section 1, the pitch, a coastal eco-resort in Sorsogon, Philippines.
Let's start with the hook. What exactly is the project proponent, Raymund M. Bongalosa, actually building in Bongalosa? Well, the core of this pitch relies on a really stark contrast. The source material notes that unlike the standard status quo accommodations you'd usually find in the Bicol region, this project promises a fully integrated ecosystem. We're talking about modern, multi-story eco-lodging, a private port for yachts, an on-site PADI-certified dive center, and 24/7 emergency response security. The whole strategy here is to capture that premium, high-spend ecotourism traffic. They're specifically targeting enthusiasts who flock to the region for those famous whale-shark interactions and Tikay Pass scuba diving. So they aren't just building a hotel, they're trying to build a comprehensive adventure destination.
Moving on to Section 2, the structure, building the investment blueprint.
Okay, so let's say you like the idea of capturing all that premium ecotourism. But before you go writing a $10 million check, you really need to uncover exactly how this investment is legally structured. What's actually pretty fascinating here is the mechanism they use to protect your capital. The deal is structured as a secured project financing facility and joint venture hybrid. What does that actually mean? Well, it means your investment goes directly into a special purpose vehicle, or SPV. Think of an SPV like a protective vault. It's a dedicated Philippine corporation established just for this specific project, keeping it totally isolated from any of the proponents' other business dealings. By doing it this way, you, the investor, maintain a priority lien and senior claim on all the project's assets until your capital is fully redeemed.
Now, if you're an international investor, your very next question is probably going to be about foreign ownership, right? Well, the source document addresses this head-on. Under the Philippine Foreign Investments Act and Omnibus Investments Code, foreign nationals and entities can legally own up to 100% of export-pioneered or tourism enterprise zone projects. Plus, profit repatriation and capital remittance are fully permitted through registered foreign investments with the central bank. That ensures a seamless repatriation of your returns and principal payments. Basically, investors are legally in the clear to own and extract profits from this development.
All right, Section 3, the funds. Where is the money going?
We've established the legal vault, so now let's look at the financial blueprint and see exactly how they plan to spend your $10 million. Looking at the capital allocation strategy, almost half of the entire facility, that's $4.5 million, goes directly into the fixed asset of the 8-story tower itself. The rest of the funds is strategically distributed. You've got $1.5 million to secure the coastal land, another $1.5 builds the marine infrastructure and ports, and an equal $1.5 million equips the resort with physical fleets, things like jet skis, speedboats, and dive gear. Finally, $1 million is set aside for security infrastructure and a really vital working capital contingency buffer. You aren't just funding abstract concepts here. Your money is literally being converted directly into hard, tangible assets.
But as you know, building an 8-story tower and a marina definitely takes time. You also need to know the execution timeline. The document outlines a rigid 24-month construction period. Phase 1 covers the first 6 months, focusing on permitting, site grading, and crucial marine port piling. Phase 2 accelerates through months 7 to 18 with the vertical construction of the tower and the breakwater. And finally, Phase 3, which encompasses months 19 to 24, covers interior fit-out, delivery of the watercraft fleet, staff recruitment, and a pre-opening soft launch. It's a pretty aggressive, milestone-driven runway, and is designed to get the resort operational and generating revenue as fast as safely possible.
Which brings us to Section 4, the returns. How do I get paid?
So, after 2 years of construction, how does this property actually perform? And, more importantly, how do you make your money back?
Well, the financial models project that by years 8 through 10, the mature resort targets $5.5 million in gross revenue, yielding a really robust net operating income of $3.4 million. And these numbers aren't just pulled out of thin air. They're based on a blended revenue stream. The model assumes a realistic 65 to 75% room occupancy for the suites, but it heavily bolsters the bottom line with high-margin marina berthing fees and high-turnover daily rentals from the water sports and dive excursions.
Now, a crucial point for anyone evaluating this deal is understanding the initial waiting period. The term sheet includes a 2-year moratorium. That's essentially a grace period on principal repayment during those first 24 months of construction. Why do that? Because it ensures that early cash flows and drawn funds remain strictly within the project to actually fund the vertical construction and operational setup. You definitely don't want the project immediately bleeding out cash to service debt before the doors even open.
Once that 2-year moratorium wraps up and the resort is officially operational, the targeted annual yield kicks in. On this 10-year repayment term, the pitch is offering a really attractive 13% annual return on investment. This is a fixed return debt component, paid either annually or quarterly, and it's designed to provide a predictable yield backed by the property's varied revenue streams.
Now, predicting revenue is one thing, but how do you actually guarantee order when the cash hits the bank? They use a strict payment waterfall. Step 1, operational expenses and routine maintenance are paid just to keep the lights on. Step 2, taxes and regulatory fees are cleared. Step 3 is you, the investor debt service. So your 13% ROI and principal amortization is paid out. Only after you are completely paid do we reach Step 4, where the project proponent can take their distributions or retain earnings. You are structurally positioned right ahead of the developer's profits.
Moving on to Section 5, the risks, evaluating the safety net.
Listen, no multi-million-dollar pitch in an emerging market is complete without asking the most important question. What if things go sideways? What exactly is the safety net? Let's look at how the proponents build a wall of security around your capital. The $10 million facility is heavily backed by a comprehensive collateral package. That SPV structure we talked about earlier, it grants you a first priority real estate mortgage over the coastal land title, the 8-story tower, and the marine port. Plus, you hold a chattel mortgage over the physical watercraft and equipment fleet. And all of this is protected by comprehensive constructors' all-risk insurance during construction, which transitions to marine hull and business interruption insurance during operations. So if the project fails, you have first rights to seize and liquidate prime coastal real estate and physical assets. On top of that, as an investor, you are never flying blind. The governance structure is highly transparent. You'll receive monthly executive summaries and quarterly operational reports. Interestingly, these quarterly reports also track their ESG benchmarks, like solar integration and a zero plastic policy, as well as their strict 60% local hiring mandate. But most importantly, you are granted full annual independent audit rights. Complete with transparency over the project-level bank accounts, you can literally verify every single penny.
And finally, Section 6, the exit. When do I get out?
Every smart investment needs an exit strategy. You obviously don't want your capital trapped forever, and this 10-year term provides very clear, defined off-ramps. When year 10 arrives, you have a few options. You can simply ride out the full principal redemption via the completed amortization schedule, or, if the property is booming, you could trigger a structured equity buyout. Alternatively, the SPV allows for a straightforward third-party asset sale, or even refinancing the asset to return your remaining capital. The whole structure is designed to give you liquidity at the end of the term.
So we've broken down the legal protections, the ambitious use of funds, the strict payment waterfall, and the hard collateral. The proponent is offering a 13% yield in a booming ecotourism market. But it also requires navigating a complex 2-year ground-up build in the Philippines. So the ultimate question really is up to you. Is the structure and the yield enough to anchor your $10 million, or does the construction risk leave you waiting on the shore?